Thank you, Kirsten, and hi, everyone, once again. Yeah, let's get started. So in my time advising across the flexibility of storage space in Great Britain, I've seen plenty of developers with really sharp ideas. They have strong business cases. They're looking to build the right thing in the right place at the right time. But here is the truth. The truth is that not all of these ideas ever make it off the spreadsheets and the presentation slides and into operation. Why, you might ask? Well, this is because these developers couldn't get the financing over the line. That is the hard reality that a developer faces sometimes. No matter how good your concept, the journey from vision to cash flow always starts with finance. That's why I flipped the order a bit around, maybe to Kirsten's surprise as well. Instead of monetizing, contracting, and financing, we'll go in the order that projects really unfold, which is financing, contracting, and monetizing. First, you raise the capital, then you secure the market access, and only then does the battery start generating returns. Over the next 20 minutes or so, I'll unpack what's working, where the risks are, and what's driving successful projects in Great Britain's fast evolving storage space. We'll have some time at the end for Q&A. As Kirsten said earlier, my name is Sam Eberhorn. I work at Baringa, and I'm an expert in flexibility and storage. I also lead our flexibility products, which include our flexibility market reports. My goal is to leave you with practical insights about how you can use whether you're developing, investing, or simply tracking the market. So let's get started. So a quick word again about Baringa. We are a global advisory business. We have 2,000 consultants worldwide. We work across sectors like financial services, government, and crucially, energy and resources. We have an international presence with offices close to both our clients and also the markets that we help them to navigate. Energy is at the heart of what we do. We have over 800 people that are dedicated to the energy sector. Through a mix of our market projections and our gross margin projections, advanced analytics and broader advisory, we've supported over 150 billion US dollars of investments into low carbon technologies, which help to shape the transition to a cleaner and more flexible energy system. Whether it's policy shifts, market volatility, or technological change, we work side by side with clients to solve their toughest challenges and seize the emerging opportunities. Okay, we're diving right into financing. Long-term battery gross margin projections, they enable investors to assess upsides and downsides, allowing them to make decisions that align to their risk appetite. So on the left of this slide, you'll see a representation of our end-to-end modeling framework. We have an internally consistent framework. We model markets where we project prices, and downstream of that, we model assets such as battery storage projects where we project gross margins. In our H2 2024 GB flexibility market report, under our reference case, which is our central view, for a 2-hour battery, we projected that on average, a battery would see £93 per kilowatt per year of revenue during the 2030s. You can see on the right of the slide a representation of that gross margin stack. We have a number of elements which are used to derive this gross margin. You can see the day ahead component. You can also see the volatility value around that day ahead as the traders are able to optimize and react to short-term shocks and fluctuations around the deterministic price series. You also see intraday market, both the physical delivered intraday value, as well as the ability to churn, to get into an intraday price spread and exit that price spread ahead of delivery. You can also see the contribution from ancillary services such as frequency response as well. The bulk of the value is derived from energy arbitrage. So this is using the battery to take advantage of day ahead, intraday, and balancing mechanism spreads. The review of electricity markets is underway. We have to note that very clearly in Great Britain. This is a government-led initiative which will potentially lead to a move from the current 1 GB zone to multiple zones for wholesale power. It's expected that we would have some next steps regarding REMA by the summer this year, with implementation of the potential splitting of the GB market to take place over a number of years. However, under the current market design, the day-ahead component makes up about 25% of the total gross margin stack for this 2-hour battery. If we were to move to multiple zones, we could see a deviation in the outcome for the day-ahead component to plus 30% in the highest zones to minus 15% in the lowest zones. There is a geographical dimension. Broadly speaking, the more north you are in the country, that's where you would see the lowest zones in terms of outcomes for batteries, and the more southerly you are in the country. So south of London is where you would expect to see upward outcomes related to the day ahead component. There is also the potential for locational impacts to be seen to the other components of the gross margin stack as well. So it's important that you have the guidance of an advisor who can look at alternatives in market design, assess sensitivities to price volatility, to commodity prices such as gas and carbon prices, as well as the impact of generation mix. The financing of batteries in Great Britain has evolved over the years. So we've gone from pilot schemes to a mature market with diversity in the available financing models. And this is how. Pre-2015, pilot projects and grant-based funding was how the capital was brought to bear to see the early projects seeded. Then between 2015 and 2018, which we've called the early commercialization stage, here is where we saw vertically integrated utilities and independent power producers financing the early projects from their balance sheets. These projects in that early period were still relatively small, in the tens of megawatts and sometimes in the single-digit megawatts. Then we move into the scaling up phase between 2018 and 2021. What we saw here is as the battery cost began to decline and the grid operator recognized the value of faster acting frequency response, other players started to show interest alongside the vertically integrated utilities and independent power producers. The early business model still relied heavily on frequency response services, such as the Enhanced Frequency Response Program, which had launched in 2016. We also saw specialized infrastructure funds, such as Gore Street Energy Storage Fund, Gresham House Energy Storage Fund, and also Harmony Energy. So they were deploying public equity to bring the battery projects to bear. And finally, this takes us to where we are now, where we have market maturity and a diversity of financing options. In addition to commercial banks, which are offering debt financing for battery projects, now we've seen the rate of interest reduce in the market maturity phase. We're also seeing less requirements for guarantees due to a better understanding of the risks associated with this type of investment. We have seen an evolution as well in the debt financing. So we're seeing accelerated repayment during high cash generating periods as well. So just summarizing, we're seeing equity, private and public, We're also seeing debt financing, with debt, the leveraging potentially going up to around 70%, depending on the contracting approach. Our role as an advisor has also evolved over this time period. So initially, in the early stages, we were providing foundational knowledge, helping people to understand the regulation and the policy dimension. And now we are providing insight into the projections and capital enabling, providing support around lender market advisory. We also providing support to help people to access the markets through their contracting approach, as well as providing support to help people to build their own trading and optimization capability as well. Okay, moving on from financing to contracting. Contracting structures typically reflect the asset owners and investors' financing strategy, their maturity in the space, as well as their risk appetite. A blended approach is good. There are broadly four different route to market approaches for batteries in Great Britain. Firstly, we see tolling agreements, both physical and financial tolls. Secondly, we have revenue guarantees such as floor pricing. Thirdly, we have revenue or profit sharing. And lastly, we have execution only service, where effectively market access is being provided to the owner of the battery. Risk transfer from the perspective of the asset owner investor is greatest under a tolling agreement. And the type of risk we're talking about here is the revenue risk. It can be the case that the other types of risk actually increase in a tolling agreement versus the other forms of market access. There's a clear trade-off as you move from left to right between the upside. Under a physical toll, the tolling agent is keeping all of the upside in exchange for security around the revenue and a relatively long tenor, so contract length. Tolling agreements and revenue guarantees such as floor pricing are more bankable, meaning that they are better able to help an investor to get debt financing. This is because of the revenue certainty that they provide. Of course, the counterparty and the risk or lack of risk around the counterparty is really important, especially in the tolling agreement. We're likely to see more announcements on tolls as time progresses, and we're also expected to see an evolution of those terms as time progresses as well. Tolls are relatively new, physical tolls in Great Britain, but we are likely to see that propagate and see more financial tolls as well. There is actually a fifth option, a fifth approach, which is starting to emerge, and that is where an owner of a battery is doing their own in-house optimization. So we could call it do-it-yourself or DIY. One of the clear incentives around this approach, the DIY in-house trading approach, is as you build capability and the amount of capacity that is in operation, the amount you're paying out in fees, the costs of the market access increases over time. So there is an incentive to try to save this money and instead build the capability in-house to optimize the batteries. Even if the incentive is clear, which is to reduce fees and costs, that doesn't mean that it's easy. So to become a good optimizer, it requires a party to successfully replace the people and the processes that are held by their optimizer market access agent. Therefore, deciding if this is the right next step for the owner is something that we as Baringa help with, as well as ensuring that they are able to make a success of their journey of in-house optimization. Okay, so now we're on to monetization. There's a lot on this slide. Maybe we can come back to some of the details in the Q&A, But what I really wanted you to focus on was the journey, and apologies to anyone that's colorblind here. So what we're seeing is response services in a kind of red pink color. And as we move on, we've got day ahead and balancing mechanism in blue and gray respectively. Successful monetization of batteries does require optimization adaptability. An optimizer must react quickly as value moves between the different revenue pools. So what we see laid out in the chart is the job of an optimizer, it would appear, was relatively easy. And I'm saying that in inverted commas, because I'm sure they would tell you that it wasn't an easy job. But between 2020, January 2020 and December 2024, the bulk of the value for the batteries that were optimized in Great Britain derived from frequency response, the response services. But over time, as we started in 2024 and to date, we've seen a shift to energy arbitrage and the day ahead and the balancing mechanism. So it was important for optimizers to make that shift from the saturated ancillary services spaces, which really buckled under the weight of battery capacity, to the deeper revenue pools that the energy arbitrage markets of day ahead and balancing mechanism provided. So they needed that adaptability to shift their focus as the value shifted between the different markets. It's also worth pointing out from this chart, as you can see, that peaks and troughs in battery performance are normal. It just has to be said that the implications and the structures around these peaks and troughs need to be fully considered. It's also worth noting that some optimizers were quicker to respond to the changes that we saw from response services focus to a energy arbitrage focus than other optimizers. In 2024, the top performing batteries were those that were predominantly focusing on energy arbitrage in the wholesale markets, the day-ahead market, and the balancing mechanism. All of the batteries listed here are 2-hour batteries. All of them were optimized by Centrica, EDF Energy, or Tesla. And they were predominantly, as you can see, based on the colors, hopefully, they were predominantly focused on energy arbitrage in the day ahead and the balancing mechanism. So it's important not only to us understand how the aggregate fleet is performing and where they're deriving value from, but how the individual assets are performing and how portfolios are performing and how optimizers are performing. When you're able to compare to add backward-looking optimization, so where you're putting historical price outcomes of day ahead, intraday, and balancing mechanism price, as well as ancillary services prices, into a battery asset model such as our own, and look at those outcomes in terms of gross margin alongside what has actually happened in the market, you would be able to get the most out of the optimization relationship that you have, as well as if you were doing that optimization yourself. So the benchmarking of battery assets, the portfolios, and the optimizers is a key part of the advisory capability that we have here at Baringa. And it's important for you to get the best out of your optimization relationship or the optimization you're doing in-house. Okay, so now we've finished monetization. So we've moved from financing, contracting, and finished now monetization. So we're just kind of coming in for a landing now. So what I wanted to say is that the rapid growth that we've already seen in battery capacity in Great Britain is expected to accelerate even further. And there's going to be a clear shift from short duration to longer duration batteries. The installed capacity of batteries in Great Britain at the end of 2024 was 5 gigawatts. So we moved from effectively zero capacity to 5 gigawatts in a decade. However, over the next 5 or so years, we're expecting the capacity to grow to approximately 19 gigawatts. So we're expecting to see 19 gigawatts by 2030. and we're expected to see circa 24 gigawatts by 2035. So a significant shifting in the pace of deployment in the coming years. These projects will be larger, so they will take up less efforts in a way. They will be larger projects, so we will see more gigawatt scale projects, the projects in the gigawatt scale, as well as longer duration, as I mentioned before. So increasingly, they will be over 2 hours in duration and above, especially as the market moves into an energy arbitrage phase. You need batteries with longer duration. Okay, so just to sum up, with 5 key considerations for developers and investors looking to invest in projects in Great Britain. So firstly, projections are important to investors and lenders to assess the upsides and downsides. They should make decisions which align to the risk appetite. It is very important to understand the modeling framework, as well as understand the impact of market design changes, as well as impacts through sensitivity analysis as well. Battery financing in Great Britain is a diverse space with a number of available financing models. We have private equity, public equity, and debt financing options available. And just to come back on the debt financing, it's quite a mature space now in Great Britain. We have accelerated debt repayments. We have relatively high levels of gearing as well, which are possible, dependent on the contracting approach. The contracting structures should reflect the financing strategy, the maturity, and the risk appetite of the owner. And it's good to blend the contracting structures in a portfolio and evolve those over time as you become more mature as an investor, and potentially to reach the boss level, which is to optimize your own batteries. A good optimizer is an adaptable optimizer, able to react quickly as value moves between the different revenue pools. Benchmarking is essential to ensure that you select the right optimizer, you manage the optimizer relationship, or to make sure that you are doing a good job if you're optimizing yourself. And lastly, the battery deployment expected in Great Britain is going to accelerate with a clear shift towards longer duration. Costs of batteries are expected to continue to fall, and the opportunity that is present in energy arbitrage will require longer duration batteries. Okay, that concludes the presentation proportion of the webinar. My details are here, and also how to get in contact with us at Baringa, just in case you wanted to continue the conversation. So I was going to hand back to Kirsten now so that we can open up the Q&A section of our webinar. Thank you very much for listening.
Yeah, thank you, Sam, for that interesting presentation, also the interesting insights, especially with the international dimension and the dimension of Great Britain in energy storage. As you said, we would now move to the Q&A session, and you elaborated early on the modeling framework. A question regarding this. Could you say that the modeling framework gives more transparency to the investor? And is that maybe a factor that leverages his risk appetite, as you said?
Yes, no, I think it's very important to understand the framework and how it actually works. I think the days of a black box are over, and an investor and a lender will want to understand how the assumptions, I think that is critical, not just the mechanics of how you're deriving or forming your price view, but the assumptions that are used to drive that view. So assumptions around capacity mix, assumptions around commodity prices, assumptions on the rate at which batteries are deployed in the market in question, and also other competing technologies, because it also needs to be clearly understood that it's not just batteries which are capitalizing on the opportunity of that flexibility provides, but other types of flexible energy resources such as peaking engines or reciprocating engines, even CCGTs, sorry, combined cycle gas turbines and other thermal power generation, interconnectors as well. So providing transparency on the how the model works, the assumptions, the what assumptions have gone into the modeling, are crucially important to then be able to make informed decisions that align with the risk appetite of the investor. It could be that the investor has different views on commodity price or capacity mix, and the modeling approach should be adaptable to incorporate those assumptions if the investor is or the lender is determined to see the impact of those views as well. So yeah, it's crucially important.
Yeah, what I think is very interesting is what you said, that you, as an investor, make an informed or want to make an informed decision. And the more data you have and the more information you have, the more informed will be the decision be. And you also said earlier on that in contracting structure, the interests of the asset owner and the investor have to be kind of blended. So they have to work together and kind of cooperate. So this is not a one-sided approach. In terms of battery energy storage systems in different countries and the comparison, in which phase would you say, compared to the UK, would you place the development of battery energy storage systems in Germany?
It's a great question. So let me just bring back up the I guess this slide, and also the investor, sorry, the advisor role that we played in order to answer this question. I would say I would place Germany in between the early commercialization stage and the scaling up stage. I think we're still seeing vertically integrated utilities and the IPPs financing projects from balance sheet. Um, there has been some willingness of the public listed funds that we have to deploy capital to bring projects to bear in Germany, but this is relatively limited. I think we also seen commercial banks taking their learnings from GB and providing debt financing in GB. So I would definitely say somewhere between those two places. I think there's still some maturization, is that a word? That needs to take place for the fullness of the diversity of financing models to become available in Germany. But the German market, don't want to underplay this, is one of the most exciting markets for flexibility and energy storage, such as batteries in the world. Actually, given the structure of the market, the amount of intermittent renewables there are, the interconnectedness of Germany to other markets as well, the liquidity of the wholesale markets, the day ahead, and the intraday market. So, although maybe not as mature, I think the opportunity is actually greater than the opportunity in Great Britain. So there's a lot of excitement, rightly so, about the German market.
Yeah, your view is quite surprising to me, I would say, because I would have placed Germany at one of the most earlier stages. But I think this is also a question of the information we get also in Germany on that, because inside of Germany, in comparison to other countries, the view is very persistent that we do not have that development. But it's very interesting to see that we are quite on the way to being mature. Yeah, coming back to the individual financing models you elaborated on, would you say that the success model of battery energy storage systems in Great Britain has the fundament in these individual financing models?
I would say one of the success factors for Great Britain The reason why things have worked as well as they have is we've had a financial capital in London, so lenders um, at the cutting edge that are proximate to the market and the developers and investors as well. So yeah, the financing, debt financing has been really important. I think we're expecting to see more debt financing come to play in Great Britain as well. So as well, we've had the funds, who have significant presence in the UK. There's a few of them come to mind, such as KKR and others. So yeah, financing and London's place as a financial hub. Obviously, Germany also is a financial hub as well. They have been really important to the success of the GB battery deployment as well. And then taking the projections that we produce and understanding those has enabled people to make the investments on the right terms in terms of their risk appetite. So yeah, it's a combination of having the right people at the right play in the right place has enabled GB to see the success that it has in terms of financing.
Mhm. What I think is very interesting is that this is kind of a two-way process because on the one hand you have the development of the technology and the more experience you have with investing in this technology, the more experience you also have with the financing models,
Mhm.
and the more diverse the financing models are, the more um, yeah. Successful will be the technology in the
Yeah,
market, and I think that's very interesting. Regarding energy arbitrage, you
yeah.
elaborated on. What do you say to the critique that energy arbitrage does not contribute to stabilizing the electricity grid?
Um, yeah, it's a great question. I would say it does by its very nature. So what you're doing when you're doing energy arbitrage is you are shifting effectively energy from places where typically the demand for it is low and the price is low to periods where the demand for that energy is higher and the price is higher. So you're effectively flattening the the profile of price, and you're moving supply out of the troughs of demand and into the peaks of demand. So I believe in its very nature, you are supporting the transition, because it's typically the case that we have intermittent renewables which are in excess in these periods, and we need to move that energy. And that's what a battery is doing. It's charging and ingesting this um, relatively cheap intermittent renewables, which is being produced sometimes at the wrong time, and moving this into periods where it is better used. Additionally, the batteries, even when they're doing energy arbitrage, they're able to, provide some um, resilience to the system. I know Germany has grappled with the question as to whether they should introduce a capacity remuneration mechanism. But yeah, I think batteries, alongside their energy arbitrage role, have a role in that kind of resilience, or reliability, I should say, of the system as well. And as we have sadly seen in the case of Iberia in recent times, I think there is really no price you can place on kind of having that reliability of a system. So yeah, I think in the very nature of their job in arbitraging, they are supporting the grid. Additionally, they have the ability to provide that reliability, and they also support the operability through providing the system services that are required, whether that's frequency response or FCR in the German context, or through reserves such as the AFRR and MFRR as well. and they have a potential of playing a broader role in voltage control and stability services such as inertia and short circuit level. I think these services tend to be forgotten, but the power system fundamentals require them to be provided. And if we are transitioning out of the market, coal-fired power stations and hard coal and lignite, who have historic and nuclear, which is gone in the German context, which have historically provided these services, then batteries are well placed to step into that void. So alongside energy arbitrage and the reliability they're able to provide, they're also able to support the operability of the system, which is definitely required, and they will need to step into the void left by the fossil-fired generation.
Yeah, thank you for pointing out the potential of energy arbitrage for the electricity grid, because I think this different view also influences the investor who says, okay, I want to kind of invest in this kind of project, and if you have or if you hear the critique that energy arbitrage does not really contribute to stabilizing the electricity grid, this may be also influencing your decision. Yeah, thank you for those insights. Regarding your model in Britain, have there been government subsidies in the UK that have accelerated the development of the battery storage market?
Yes, there definitely has been. So coming back to this early stage, we saw um, public grants. So we had organizations like the Innovate UK, Ofgem, which is our regulator of electricity and gas markets. Also, they provided some subsidy or public funding as well. But this has been quite a long time ago now. So it was very useful. And also just to draw reference to the German case, because we have been supporting people who have been looking at the innovation tenders where, a battery is paired with a solar plant and the facility is in receipt of, kind of a feed-in tariff. So this is a form of, I guess, public funding, to in the battery space, although it's in this hybridized, co-located form. So yeah, this is all very important and was necessary to kind of seed the market. But currently, we're in a place where the majority of the value for batteries is being derived through merchant markets, so going into the wholesale markets and the balancing market mechanism and ancillary services spaces, and effectively operating the assets there to derive value. We have a capacity market in Great Britain, so but the consumer pays for that. So it's hard, you can't really describe it as public funding as such. So yeah, I mean, it was crucially important to seed and to start the market and to fire the starting gun, but effectively public funding has been withdrawn. We do still have some funding for innovative chemistries and technologies in the energy storage space, but a lithium-ion battery is a very mature, established technology which is not in need of this type of funding anymore for a long time.
I like the term you used, that it kind of served as firing the gun,
Yeah.
because you may also heard of the discussions on government subsidies for this kind of market in Germany. So I think your clear view on that and the clear development in Britain shows that the government will also have to play a role in developing these technologies, because it kind of is a factor, of course, in giving information also on the technology for investors. You elaborated earlier on the factor or the development of the review of electricity market arrangements, the REMA, and what I ask myself is, how could that change your work at Beringer? So in a positive way or more in the negative space? What would you say?
Um, I wouldn't describe it at all as negative.
Mhm.
In terms of our role as Bringer, we are incredibly geeky and we like complex problems. I think the complexity of the problem definitely has increased, which is kind of more meaty for us to answer as advisors. Um, there are concerns by investors and lenders about just change and uncertainty and the implementation timeline, um, and liquidity. If you move to smaller markets, liquidity in the wholesale market has been a long-standing, let's say, concern in Great Britain, not at all a concern in Germany, where the liquidity is very high in the wholesale markets. We've had periods of intervention by the regulator to support liquidity. And there is a concern if you move to smaller zones that this could challenge liquidity, which then challenges the monetization, which then is a feedback loop back to financing, and then people struggle to get financing to bring the projects to bear. But we at Baringo, we believe we're well placed to answer the questions around the change in market design. We have a zonal model that we're already using to provide advisory to clients as they prepare to kind of, they're anticipating this change. At Baringa as well, we are advising and working with the government and working with the regulator, working with the system operator regarding this change. This is another division to myself, so we have to operate quite carefully to make sure this work is siloed. So yeah, we are well placed to support people in this through this change. So we wouldn't describe it as negative. We want to work with the market that ensues. We're hoping for clarity sooner rather than later. So hopefully by the summer, we will have the next steps. Will be clear. And I think the thing that is very clear is that location will matter even more than it currently does. So it could be that, developers and investors need to think differently about where they site projects, and maybe work a bit harder to understand where the premium sites and premium locations are and why. So yeah, we're looking forward to continue supporting people through that.
I very much like that you said that you don't deem that negative at Beringer,
Yeah.
and that I hear from your words that you are very well prepared for this expected change. Um, a more specific question from the audience: what are the
Okay.
capex per kilowatt for BESS in Great Britain?
I don't have this to hand. Maybe it's something we can share afterwards. Um, but yeah, I mean the capital expenditure for batteries is, as I mentioned, declining over time. The component which is declining the most, there was some challenge on this component. The battery pack is what I refer to, or battery cells. There was some challenge over the last few years. We saw the maybe actually costs went up. Periodically there was some supply chain challenges, but we've seen that reverse and the downward trend continue again. And we expect that to continue further on. We have been reflecting on the potential impact of the tariffs which have been proposed by the US president, and whether that could impact the trajectory that we have anticipated. So, I probably I can answer the question as kind of a different way. We're expecting internal rates of returns for battery projects to grow as projects are developed into the the late 2020s and into the 2030s. So this is a combination of declining capex as well as a growing opportunity through energy arbitrage. But I can come back maybe more specifically with a view on capex. We have views on this by components, battery pack, balance of plant, inverters, transformers, um, by market. So for GB, for Germany, for other European markets, other global markets as well, and how that evolves over time. So that is a key component of the advisory we perform here at Baringa. But I just apologize because I don't have those numbers to hand right now. But I'm happy if the person has left their name or contact information, I can kind of circle back on that later.
Yeah, thank you for the offer, of course, and for elaborating on the topic that in depth. Maybe last topic I would like to touch upon is the different views in the different countries, because Beringer has also offices in the US, Asia, and
Mhm.
Australia. Could you maybe give us a short kind of comment on how the view on energy storage systems differs from these countries?
Yes, yeah. No, it's a great question. We're effectively seeing a good opportunity for energy storage and flexibility broadly in a number of markets. I think one which maybe we haven't mentioned is Japan. So this is an area where we provide advisory. So we are seeing strong, outcomes for batteries and energy storage in that market as it goes through transformation and becomes a more open market. I think very recently we had news of debt financing of a battery project, utility scale battery project in Japan as well. So that is one market I would call out. I would also call out maybe some markets in Europe that are off the trodden road, so to speak. So some of the markets in the Baltics, I would say are interesting. Markets like Lithuania, are interesting as well. So coming to the US, I think ERCOT is for better or for worse, it has chosen to be a kind of an islanded type system like GB, in a way. So I think there is value for, strong value for battery storage in a market like ERCOT as well. But yeah, we are maintaining views of, all of these investable markets. So, if somebody wants to reach out for more qualitative as well as quantitative perspective on the different markets and a ranking on this, we can provide this. We are also about to launch a battery attractiveness, storage attractiveness index. So this will look across the world and give our viewers to which are the top markets and why. So this insight is coming from us in the next month or so. So yeah, that ask people to look out for that.